as Jerry mentioned, I'm an alum, a very proud alum from the class of 2001. I set foot here first in 1999, so I thought what would be helpful is when we talk about financial markets going forward, you always have to look back, and if you're going to spend 30 minutes, which I think I have allocated, you got to spend 90% of your time looking historically to be able to understand the 10% that you're going to look into the future and try to figure out what's happening. So we can go back into history as far as we want. I actually chose 20 years, partially because I was here 20 years ago, but I think once you start going back 10, 20, 30, 40, 50 years ago, you can pick any point in time you want, but you start losing relevance a little bit. So what's happened in the last 20 years? When we talk about economic and market statistics, the US GDP has roughly doubled. It's gone from 10 trillion to 20 trillion. The world GDP has grown a little bit faster. It's gone up 2.6 times as opposed to 2 times, and that's mostly on the back of the growth in Asia and some of the emerging markets that have done very well. How's the S&P index, the S&P 500, which really people look as the benchmark equity index? It's up 2.4 times coincidentally in the last 20 years. So somewhere right in between where the US GDP growth has been and where the world GDP growth has been. And it's not just a coincidence. Most of the S&P 500 companies now are global. You look at Apple, Microsoft, GE. These are big global conglomerates, and so they benefit from international growth as well as US growth. What I then did was I broke this into three sections, actually. Section 1, we're going to talk about the last 20 years. Section 2, we're going to talk about the last 10 years. And then Section 3, we're going to try to look forward. And the reason I bifurcated it into the last 20 years and the last 10 years is I think they're very relevant. If you pick a point in 1999, when I started at Anderson, to 10 years later, and you could pick Q1 of 2009, Q2, some quarter there, the S&P 500 is actually down 50%. So if you were Rip Van Winkle and you fell asleep in 1999 and woke up in 2009 and you looked at your stock portfolio, you would have thought, what's going on here? This is impossible. But if you fell asleep and woke up 20 years later, you would have done fine. And had you woke up in 2009 and had dollars to reinvest, those dollars would have done very well. And if you invested just in the S&P, it would be up 400% from 2009 until 2019, which is incredible. You look at the fixed income, 10-year Treasury is really the benchmark. The US government bond is what's considered the risk-free rate. The 10-year benchmark is really what people look at. What I put there is the yield. So the yield on the 10-year Treasury when I started business school was 6%. So the risk-free rate, meaning if you were to buy 10-year government bonds and just sit there and let them accumulate, you were making 6% a year, which in today's interest rate environment seems phenomenal. But you look at today, we have a 10-year Treasury at about 1.7%. That changes day by day, but it's about a quarter of what it was before. And being a fixed income and a credit guy, I think it's pretty remarkable, and we'll get into some slides why I think that's so remarkable. Along the way, there's been a lot of events. People love to focus on the negative events. There's been a lot of positive events, but I pointed out a couple of the negative events. When I was in business school in 1999, we were looking at tech companies, and we were trying to figure out how to value them, and it was a whole different way of how to value companies. Instead of your traditional PE metrics, EBITDA multiples, cash flow, we were suddenly looking at revenue multiples, eyeballs, clicks, and things that we never historically looked at. That led to a dot-com crash. It was really an income statement crash. We had companies that were valued at 200 times revenue. Those were 2 years forward revenue. Nobody knew what the revenue was going to be 2 years anyway, so how could it be valued at 200 times 2-year forward revenue? And we know where that went. We had the global financial crisis that really led from subprime and leverage, and those were dark days, which we'll get into a little bit. I highlighted the European sovereign crisis here because I think globally it was very interesting. I worked at a hedge fund, as Jerry pointed out, for 11 years. If you ever worked at a New York-based hedge fund, it's kind of like dog years. Each year is worth 7 years. So I did quite a lot. And when I was in London, I ran our European office. I was sitting there in 2011 and 2012, and Greece was going to default. I think Professor Lemer mentioned Greece before. What was remarkable about it was the U.S. economy, and not the economy, sorry, the U.S. market actually started to react in the middle of 2011 and fall as well. So the S&P started falling. There was a lot of volatility in the market. And when I was sitting in London and I picked up the phone and I called my guys in New York, I said, hey, what's going on in the U.S. markets? They said Greece. And what's amazing about that is Greece has the same population as Georgia. And no offense to Georgia, it's a lovely place. I've been there. Lovely people. If you talk to somebody in Greece about what's going on in Atlanta, Georgia, they don't care. So when you talk to someone in New York about what was going on in Greece, it was pretty remarkable, but really what it was is similar to the subprime crisis, it was a domino effect. Greece did end up defaulting on their debt. People thought that would lead to Portugal defaulting, then Spain, then Italy, people getting kicked out of the euro, and the whole euro potentially collapsing, which was a big deal. And then in 2015 and 16, we had an energy and commodity market downturn. Very similar to what I just mentioned with the European sovereign crisis, oil prices went from $100 to a low of $25. Now they sit around $50 to $60. But if you talk to an energy trader during 2015 and 16, they thought the world was ending. You asked them, when was the next recession? They said, we're in a recession. Are you kidding? Everybody's losing their job in energy trading. It's a very small, finite part of the market, but it did have an effect on our stock market. It had an effect on our bond market and volatility, and we'll talk about that as well. So I put up some simple graphs here. Here's the S&P 500. If you look at it once again from 1999 to now, you've done very well. But from 1999 to 2009, it's been pretty flat with a lot of ups and downs. From 2009 until now, it's done extremely well. This is the 10-year bond, which I mentioned earlier. So this is the 10-year bond yield. Now remember, yields are the inverse of prices. So in 1999, if you bought a 10-year Treasury bond, you were making 6% a year. In 2019, if you buy a 10-year Treasury bond, you're making 1.7%. Now where this is fascinating is the 30-year Treasury bond in 1999, you always get a little bit of a premium because you're a longer life than a 10-year bond. So it was a little bit higher than 6%, but just to make the math easy, the way to look at this is if you bought a 30-year Treasury bond in 1999 and held it till now, your Treasury bond would be trading at 1.7% instead of a 6% yield, and so it would be trading at 140 cents on the dollar in today's prices. Along that way, you earn 6% every year, so 6% times 20 years is 120. Add the 120 to 140, you get 260. What's amazing about that is when you go back and you look at the world GDP, you look at what the S&P did, you actually made more money investing in government bonds and very safe assets than you did investing in the S&P and stocks and something that's much more volatile. Now, are you going to get that going forward at rates at 1.7%? Maybe, maybe not. I don't know. But the point is, if you told somebody in 1999, hey, invest in the US government, just buy their bonds, you're going to do better than the stock market, people would have said, there's got to be an equity risk premium. That doesn't really sound like it's going to work. And it did. And a lot of it has to do with interest rates and where we are. The 30-year mortgage. Now, this is very relevant to anyone who's a homeowner, who's a prospective homeowner. Mortgage rates, when I was in business school in 1999, were at 7.5% for a 30-year mortgage. Today, they're about 3.7%. They've roughly halved. The 30-year mortgage is generally priced off the 10-year Treasury bond. It has a little bit of a premium because banks have to lend and make money. And what's amazing about that is, if you just look at the simple math, if you took out a 30-year mortgage in 1999 at 7.5%, on a monthly basis for, let's just pick a number, a $500,000 mortgage loan, you were paying about $3,500 a month for your mortgage. In today's rate environment, for that same $500,000 mortgage, you're paying about $2,300 a month. So what's amazing about that is home prices have appreciated, wages have gone up, but your actual mortgage payments have gone down on the same mortgage because of the rate environment. What does that do? That puts more money into people's pockets, that stimulates the economy, and mortgage payments are generally people's highest monthly payment. So it's a big deal, and 35% off on your mortgage payment is great. So what has that done for home prices? Home prices at the beginning of 1999, they went up quite a lot. Everybody knows we had the housing crash. But once again, if you're Rip Van Winkle, you fell asleep, you bought a home. Now that home, on average in the US, is worth over 2x in 20 years. So you've got a good rate of return. Most of the rate of return has been in the last 10 years. But point being, it's another asset class that's done extremely well. So let's bifurcate that once again from the last 20 years to now the last 10 years. When we look at the last 10 years, what did we have? 10 years ago right now in 2009, we were just getting over and just starting to get over what was the result of the subprime and leverage crisis, which then created a global financial crisis. Fannie and Freddie Mae were rescued, AIG was rescued, there was the bankruptcy of Lehman Brothers, which was the biggest bankruptcy in US history. What happened as a result of that? Well, the government created this program called the TARP, the Troubled Asset Relief Program. It had $700 billion worth of purchasing power in order to buy assets and put money basically back into the financial system. Of that $700 billion, and we're talking big numbers here, the government had $700 billion of purchasing power to help out the economy. They ended up using about $426 billion of it. Over the course of 3 years, $442 billion of that has been recouped, so they have made money, and it wasn't your taxpayer dollars that were spent and burned. But as a result, that stabilized the banks and the financial system. And the point of this is a lot of money was infused from the government between 2008 and 2010 in order to help the economy. So what have we had since then? We've had a 10-year economic recovery. We've had 10-year massive inflation in asset prices. And the reason I use the word massive is you look at stocks. Once again, we saw the S&P's up about 400% in the last 10 years. We look at bonds. We talked about what's happened with 10-year bonds, 30-year bonds, and interest rates. You look at real estate. But many components of the consumer price index, which is generally how people measure inflation, including transport, food and beverage, clothing, which makes up about 40% of the CPI, haven't gone up much. And a lot of that, we can argue inflation is suppressed from technology, from innovation. You look at manufacturing, for instance, it's astonishing that you could manufacture something in Asia, put it in a box, put it on a ship it all the way across, open it up in the US, get it to your retail store, and that's cheaper than just manufacturing it down the street. It's remarkable, but that's also what suppressed inflation. And you've also have massive central bank stimulus. That central bank stimulus, we'll get into a couple slides and show how massive that is, but remember the word 700 billion, which we thought at that time was massive. Wait until you see the central bank stimulus. So what happened was people who own assets, and I think this is generally a fact, they could buy more assets and likely benefited, and those who couldn't, unfortunately, disproportionately didn't. But we'll get into wage earnings growth too, and see how that differs versus the asset price growth. So we talked about the TARP program, 700 billion, big number. This is what central bank balance sheets did, even bigger numbers. And now we're getting from billions to trillions. So the Fed's balance sheet went from about $1 trillion to $4.5 trillion. The ECB's at $5.5 trillion, and the Bank of Japan's at $5 trillion. These are the three biggest central banks in the entire world that have massively bought assets, ramped up their balance sheets on a combined number of about 14 to 15 trillion in assets. Big numbers. And so what has that done? What has that done? Well, these are negative yielding bonds. So we talked about where the 10-year treasury rate was, 6% to 1.7%. Now what we've created is, because of the central bank stimulus, 15 trillion in negative yielding debt. Now, for the US, that's a little bit of a foreign concept, but we're talking about central banks like Germany, Switzerland, massive international central banks, where, in case you're not up to speed with this concept, what that basically means is you're investing in their bonds and you're paying somebody to hold your money. So in the US, if I, as an investment manager or anybody said, hey, why don't you give me your money? By the way, you have to pay me, and I'm not going to pay you any type of return. I'm not sure people would do that. 15 trillion worth of dollars are doing that right now. It's unbelievable. And a lot of that is because of the volatility, and people are scared of what's coming, global recession, but a lot of it's just because of the central bank stimulus and what's happened to the interest rate environment. So if you're in some of these foreign economies, what are you doing? You're looking at the US, and you're saying, hey, treasuries over there used to pay 3%. Those look great. Treasuries over there pay 2%. Those look great. Treasuries have any type of positive yield. Hey, that looks great. The S&P stock market pays a 2% dividend yield. That looks great. Pays a 1% dividend yield. That looks great. So there's been a lot of money that's been pumped into the US from foreign places, as well as US local consumers, and it's because we have a higher interest rate environment, and this is where you see politically, there's this whole concept now of negative interest rates, which, by the way, in my opinion, are very bad, because people shouldn't have to pay people to invest their money. And also, some of these governments, Japan, Europe, You look at their growth, you look at where they are economically, they're in a worse shape than the US. So the US should have a higher interest rate environment. We have higher growth. But the point is, this is an astounding statistic. So we talked about asset price inflation, what's gone on. This is US wage growth. US wage growth historically used to be 3, 4, 5% 20 years ago. That obviously took a big hit during the subprime crisis, but it's been recovering. And it's now a healthy 3.5-ish%, which is great, especially where it was 5 years ago or 10 years ago. But part of this is that if you look at wage growth and wage growth appreciation, and you're making 2% more, 3% more, 4% more every year, that doesn't quite compensate for the guy who owned an asset that's going up 7%, 10%, or even 400% over the last 10 years. And so this is where we've had a school of economics as well that have recently become very popular with the income disparity and how assets versus earnings and wage earners have disproportionately benefited. And you look at some of these statistics and there is some relevance there. So what's happened with inflation? Inflation is very interesting. I think Professor Lemur touched upon it earlier. CPI, one way that inflation is measured, and it may not be the best way, but it is one of the headline measures. In 1999, when I was in business school here, inflation was about 1.8%. It spiked up, it went down, it went up. But you look at today, and inflation's about 1.8%. So when the Fed is talking about how they're trying to hit this inflation goal of 2%, and that's why they keep putting in more stimulus through quantitative easing, through increasing their balance sheet, there hasn't been much of inflation in the US. And the truth is, once again, that is because of technology, that's because of innovation. A lot of things have suppressed inflation that historically in the 1960s, 70s, 80s, 90s didn't. And so getting back to inflation of 3-4%, maybe it happens, but right now we seem to be stuck in this kind of 2%-ish inflation area. The last section, section 3. So we talked about what happened in the last 20 years, what happened in the last 10 years. Let's look forward a little bit. So the lagging indicators, you look at consumption, roughly 70% of the US GDP is consumption. It's holding up. Consumers are spending. We saw Black Friday numbers, Cyber Monday numbers. I think now it's called Cyber Week, and you can buy the entire week. Soon it'll be Cyber Month. Consumption is good, though. And part of that is unemployment is low. Unemployment rate of 3.6%. That's a 50-year low. The economy is generally in a pretty good place. People have jobs. Earnings are going up. Not bad things. Some of the leading indicators, though, you look at ISM manufacturing PMI. So what that is when ISM manufacturing PMI is below 50, manufacturing is not growing. When it's above 50, it is growing. Historically, it's been above 50 for the last several years. For the last several months, though, ever since July of this year, it's been below 50. Now, the US doesn't manufacture that much anymore. We're really a services and consumption-based economy, but people like to look at this even though it's 10% of GDP, because as manufacturing starts to slow down or even go negative, that generally is a leading indicator potentially for markets. But rates is really a big concern of mine. As a fixed income and as a credit guy, let's talk a little bit about rates. So the Fed raised rates 4 times in 2018. We were on this path where we were finally increasing rates. We were getting out of a very low rate environment, and they thought the economy was healthy enough to raise rates. When they raised rates 4 times, all of a sudden the stock market twisted their arm, potentially maybe even the US administration, even though that's supposed to be separate from the central bank. And all of a sudden they started cutting. And a lot of that is because of economic indicators too. The economy started to slow down. But it's a dramatic reversal from 2018 raising rates 4 times, to 2019 cutting rates 3 times is a big reversal. And so, where are we now? Chairman Powell commented that rates were likely to remain appropriate. The market seems to differ with him. The market is implying, and there's all kinds of market indicators where you can look, and the market's actually implying a 25 to 50 basis point cut, which is 1 to 2 more cuts by the end of 2020. So I'm not sure if we're going to cut. I'm not sure if we're going to hold, but the market's saying that we're more likely to cut than to hike, which is strange when the S&P just went up 25% this year. The economy seems to be growing. We're in a lower interest rate environment, and you're still more likely to cut than to raise rates. And part of that is what Professor Lemur said about we're in this environment now where it's a little bit fiscally irresponsible. Everybody's dependent on low rates, and it's very difficult to get out of it. And so because it's difficult to get out of it, and the market is dependent on low rates right now, we seem to be stuck in a low rate environment. The 30-year mortgage rate at 3.7% is still near all-time lows. I think in 2016, it may have touched 3.5%, but we're splitting hairs and we're in a low rate environment. Equities, so the stock market. In Q3 of 2019, earnings, which is what the market is highly dependent on, were coming down slightly year over year. But the market is up in Q4, I think 3 or 4%. And that goes back to my point of 15 trillion of negative yielding bonds worldwide. Where are you going to invest? Where are you looking? You're looking at the US, you're looking at US bonds, you're looking at US stocks. So what you're saying now is you have earnings that are flat to slightly negative, although people are projecting earnings to be up next year. And the market is still going up because they're saying, hey, even if it's more expensive, I need to buy something. I can't invest in negative yielding debt. So the S&P right now is an 18 times forward PE ratio, which is historically expensive, and tech is driving a lot of that growth. I've seen all kinds of studies when you strip out Microsoft, Facebook, Amazon, Google, the S&P has done a lot less well than what is indicated. And when you think about some of these companies that are really driving the market right now, they're remarkable. I mean, they're modern day monopolies. You can't search without Google. You don't really buy anything online without Amazon. Social media, Facebook. I'm not a big social media guy, but you can't do it without Facebook. Instagram seemed like it was a great product, so what did Facebook do? They bought them. WhatsApp seemed like a pretty good product. What did they do? They bought them. So you've got modern day monopolies in tech, and they're gushing out cash, and they're very interesting companies. So because of that, that's driving a lot of the growth. So the questions come, with a lot of cash and liquidity out there, where does it go? And it's tough to argue that it doesn't go into US assets, once again, because you have positive yields here and you don't in a lot of places, foreign and globally. US stocks, potentially that's another place to go, US real estate. And that's what's created a lot of this growth. And so the reason, even though a lot of today's event is focused on California and the local economies, I started a little bit globally, is you want to see where the money's coming from. Some of it's coming locally, some of it's coming from foreign. Where is the next bubble being created, and when is the next recession? Very difficult questions to answer, but we will talk a little bit about it in some slides. So it looks a little more complicated than it is. The blue line is household debt to income. So how much debt the average household has versus how much income that they're making. And the black line is the debt to EBITDA, which is basically the leverage of investment grade corporates. And if you look at this, what happened was household debt to income rose a lot from 20 years ago to 10 years ago. And a lot of that was leverage in the system that was on the consumer balance sheet, where people were using their homes as piggy banks, they were levering up, and we got to a place that was a little bit dangerous, and ever since then, we've seen a lot of deleveraging in the consumer. So you've gone from 1.2 times to less than 1, which means people have less debt than they have in income, which is generally healthy. You've had the inverse in corporates. Now we're in a very low interest rate environment, so because of that, corporates are levering up. They're borrowing cheap. They're borrowing cheap, some to grow, but a lot of them to buy back stock. And so what are they doing? They're borrowing debt, they're buying back stock, they're leveraging up, and they're leveraging up at very cheap rates. So even though their leverage ratios are going up, you look at interest coverage, because rates are so cheap right now, you're not in a terrible place, but you are very levered as a corporate. And so, one market that I'll point out, and people say, where's the bubble, where's the bubble? It's a difficult question to answer, but this is one interesting slide. So S&P does this graph, and if you look, this is over 10 years, 2007 to 2017, and this is levered loans. So when you talk about corporate bonds, if you're a corporation, you issue a bond, you have a certain maturity, then another way to raise financing is through loans, and the loan market has grown dramatically. The biggest buyer of loans are what are called CLOs. So during the subprime crisis, everybody heard of CDOs. Those are what were absorbing a lot of the subprime and structured loans. CLOs are what are absorbing a lot of the levered loans. And if you look at the market, there's a lot of numbers here, but I'll just point to two. On the very top, the size of the market, you've gone from roughly 550 billion to about $1 trillion, so the market's doubled. That's a lot of growth in a market. And then you look at halfway down, it says triple C's. So S&P and Moody's rate these companies. And when they rate them from investment grade all the way down to triple C. The only thing below triple C is a default. So if you default on your debt, you're not paying back your debt. Triple C is generally regarded as the most speculative type of debt. That ratio has gone from 2% to 6%, so it's tripled. So what's happened is the market's grown and it's doubled. The amount of speculative debt has tripled. So it may not be a bubble, but the trends are definitely not great. And then you look at the price of the loans. So the market has gone from 2% triple Cs to 6% triple Cs, but you look at the weighted average bid price has gone from 94 to 98. And these numbers are a little bit outdated because these are 17 and not 19, but comparing 2009 and 2019 wasn't great because 2009 was kind of an anomaly year. But my point is the prices on these assets have gone up. So now your market has doubled, it's gotten more speculative, and the prices have gone up. The last slide that I'm going to point to here is, so going forward, what do investors care about? I used to work at JP Morgan. If you look, that's where I footnoted JP Morgan. I borrowed this data from them. They did an investment management survey, and they polled quite a lot of investment managers, and they said, what do you care about? If you look all the way to the right, what's extremely important to people in the market? There's two things that are extremely important, even though there's about 12 things on there. If you look at the second and the fourth thing, it's the Fed rate policy and the Fed balance sheet policy. So you combine those together, and you just have one word. It's the Fed. People really care about the Fed. And if you add those numbers together, that's what 2/3 of the people are saying they really care about. They're saying, what is the Fed going to do? Are they going to start raising rates again, and are we going to have another 2018? Are they going to keep rates stable? Are they going to lower rates, and we're going to have another 2019? These are the questions on people's minds. The other big question is, I will add number 1 and 3 together, trade policy in the 2020 US election, because I think they go hand in hand too. We've never had a US administration where you have to check Twitter all the time and see what's happening with international trade policy, but that's the age we live in. So you add those two together, and people really care about what's happening in the elections. I think Bernie and some of his policies were brought up. There's the existing policies. There's all kinds of schools of thought, and the elections are very important. But what's really important as part of those elections is trade policy, because as we spoke about earlier, the S&P and US companies are very international today. And because they're very international, trade matters a lot. And if all of a sudden they're going to have to start paying tariffs on products that they're importing, or they're going to get tariffed back on products that they're exporting, that matters a lot for earnings. That matters a lot for how they can manage their balance sheets and their budgets going forward. And so that matters a lot. And I think those are the two things that people are really concerned about in the market right now. As far as the next recession, I think it was pointed out earlier, it's very difficult to tell. When the commodity downturn happened in 2015 and oil went from $100 to $25, people were saying, hey, this is going to affect a lot of different economies, including places like the southern parts of the US. Maybe this ends up creating a recession. That kind of went by us. In 2018, with the interest rates going up and the market kind of puking a little bit for a quarter, people thought that may create some type of recession. That's passed us by and we're a year forward. So if we stay in this low rate environment, if we continue to have assets plowed into certain things, it's difficult to see a recession in the next quarter, 2 quarters, 3 quarters, but recessions happen every 5 to 10 years. So at some point, things have to give. But I think these are the two things that are really on people's minds when you talk about what investment managers are looking at. I think we're timed out.